Good morning, everyone. Tim Nyland here. Today is October 14th, and this is our weekly strategy call for Zacks Professional Services. And just wanted to comment briefly on the earnings certain family of portfolios. We are obviously enjoying some really nice performance year to date, as well as for multiple years now relative to the S&P 500. And if we forget for a moment the criteria for earning certain portfolio stocks themselves, keep in mind that ECP stocks are among some of the highest quality stocks in each of the sectors. I just want to give everybody an example of things that they can look at and monitor inside of advisor tools when we talk about the issue of sector avoidance and its impact on performance for the earnings certain portfolio. So one of the major contributing factors to the performance of the earnings certain portfolio or the family of portfolios is the fact that we don't maintain some of this, larger exposure to these very cyclically oriented sectors. So if we start with in advisor tools going to charts and pulling up our performance chart, if you have a watch list set up in your ETF watch list of the US sector spiders, I highly recommend you do this, because then you can literally just grab them and reutilize them, repurpose that list, if you will, throughout the advisor tools platform. And if you pull my list control down here, you can see I've got a myriad of ETF, mutual fund, equity watch lists that I utilize throughout the system. So I definitely recommend that. And if you just look at a year to date, in this case, we'll just look at price return for the SPY. This is the broader market. So obviously, we've avoided multiple sectors with the earnings certain portfolio, just to kind of give you an idea of why we get this material outperformance, specifically in these down markets. Keep in mind that we don't have any exposure to utilities. And so I'm just going to activate the utilities sector. And you can see that from a price performance perspective, utilities are still down year to date over 2%, and the S&P is up about 8.39. And we also don't have any exposure to real estate. And you can see real estate here is actually down about 6.39%. And again, the S&P 500 obviously in the green by 8.4 roughly. We can also add back the financials that we have no exposure to. So if you start compounding some of these sector avoidance sectors that we don't have exposure to, you'll see where we're picking up this tremendous alpha, even outside of the criteria required to be in the earnings certain portfolio from an individual stock selection perspective. So again, negative 19% here for the financial sector, and then obviously energy, which just still continues to struggle, down about 50%. So we don't have any exposure to those sectors in the S&P 500. And then when you combine, the market leading tilts that we recommend for the portfolio, it's no wonder that we're experiencing, this kind of outperformance and the ability to just sleep at night, regardless of what happens with COVID and what happens with the election. It just really doesn't matter for the earnings certain family of portfolios. So I just want to make sure that, internally that we're talking to clients about this, making sure that they're aware of not only the criteria and all of the things that go into choosing the earnings certain portfolio stocks, but the sectors that we avoid as well. And just be sure that you're actually showing this stuff to clients because it really does matter. These are all tilt-oriented sectors and sectors that, that when you own one, you pretty much own them all. So as a basket, they make up a fairly substantial weight relative to the S&P 500 overall, and that there's a time and a place for all of these. They're really not meant to be held in core all the time. And so what I want to do now is take a few minutes and look at some of the news that's been dominating the Wall Street Journal over the past week. And it's been by and large related to banks, and it's been by and large related to some interest rate expectations, perhaps in preparation for what many are saying could be a Democratic sweep during the November election. So I really want to spend a few minutes on that. And when we look at what's going on with the banks, and there were literally 15 articles over the last week, and I just picked a couple of them that highlighted some of the issues that I'm looking at. And this is really what our clients need to be aware of. If you strip out all the noise with banks, this is the stuff that really matters, right? So the idea is that banks were still expected to feel pressure on profits. But again, early cycle recovery, it tends to be where the value-oriented investors start to come in, and we've seen that obviously since the lows back here in March. People have been buying up the bank stocks in anticipation of recovery. These are your deep value investors, for which I am not one of, nor am I a fan of. If you want to, wait that long for your returns, I guess it's okay. I tend to be more of a growth-oriented investor. It's important to realize that the growth investors will obviously wait until all of our signals are a little bit more in line to actually ride more of a growth wave versus trying to, deal with this knife that has fallen and could continue to cut us, which is what's happening this week. Banks continue to struggle. The average net interest margin is obviously still down. And as I've said before, the interest rate environment is just not conducive to the most important part of a bank's business, which is the differential between lending and the rates they're paying on deposits. So those longer term loans relative to deposits. And so we're still seeing the performance of the banks struggle. Wells Fargo took a hit this morning. Citigroup, JP Morgan took hits yesterday off the back of their earnings reports. And even though these big banks beat their forecasts, right, and that's really kind of the key here, the manner in which they beat the forecast, though, was problematic to investors because they didn't have to put aside as much money to cover future loan losses. But during the earnings calls, the executives were still obviously worried that they were going to have significant losses in the future. So it really didn't bode well for investor confidence, and so the banks continued to slide on that news. And there was one article, and I believe this was in today's Wall Street Journal, that I found to be absolutely spectacular and what I had planned on discussing today anyway, which was, and this is something that Adam Cohen and many other advisors have asked me over the past several months is, Tim, at what point would you actually be interested in investing in banks? And this article hits the nail on the head, with the exception of the fact that I don't really look at the 10-year Treasury note in isolation when I'm looking to actually make investments in banks. So let me explain to you what I look at, and this is probably going to be the most important part of this call. So to best illustrate this, I like to use the Zacks research system. So we're going to switch over to our institutional platform. And many years ago, I put together a list of default templates. And my favorite one when I'm looking at spreads relative to banks is I like to look at the headline 10-year Treasury, but I like to look at it relative to what's going on the long end of the curve, okay? So I'm going to pull this chart up, and I am going to, let me see, that's already set up properly. So I already have the XLF in here. What I wanted to show everybody is in default on your system, I believe this is going to come in with the S&P 500 loaded into it. So it's going to look something like this, which doesn't tell a great story as to what's going on with financials with the 10-year and the 30-year yields collapsing. And so what you need to do is come back down here to the ETF selection. And I'll do that again just so you can see it really quickly. So for panel 4, this is panel 1, 2, 3, 4. Again, we're doing this live. Come down here and change this to ETF and go ahead and just put the XLF in here, which is the financial sector spider. And now you'll see something that is much more meaningful relative to rates. And if I take you back to this Wall Street Journal article, which is definitely worth a read, it mentions what's going on with the 10-year. And but the big issue for banks is really what's going on with the long end of the curve. And this article specifically is citing that Democratic sweep in next month's election and the potential for larger than perhaps expected stimulus pushing up the Treasury yields. So the idea is, what do I look for? And if you look at the 10-year Treasury in isolation, it's really not going to tell you much for banks. What you have to look for is signs of the curve steepening. And this is something that I love to see when you look at the 30-10 Treasury spread. So basically, you can see here that the rise in the 30 is obviously outpacing the most recent increase in the 10. And so to have the ideal bank environment for a growth investor, you want to see the yields on the 10-year rising. You want to see the yields on the 30-year rising at a faster rate, which will then expand the spread, what we call between the 30-10 on the Treasury. And this will not only result in an upward sloping yield curve, but you'll have the rate of change of the slope at the end of the curve or the tail of the curve increasing as well. And the higher the expectations for inflation at the end of the curve, the more radical that acceleration in slope would tend to be. And that is what you look for as a growth investor when trying to determine an entry point for banks. And so this is what I look at in conjunction with several other things. This is what I look at when looking at macro timing. If there was one chart I would point to, I would say that is it. So just a really, really brief discussion on my opinion of where banks are, but really good articles in the Wall Street Journal to take a look at. Relative to revisions, obviously we're entering earnings season. Lots of talk about earnings. Not only in the Wall Street Journal, but our own Sheraz Mian and his weekly earnings trends reports. Remind clients, if they're not signed up for those, that those are extremely important and will make them look like absolute rock stars during earnings season. I tell everyone that I speak to sign up for those. They are really good reports. We'll talk about that in just a minute. In this particular Wall Street Journal article, did a really good job at looking at third quarter earnings projected change. The interesting thing about this is it can be a little misleading, and I want to bring everyone up to speed on the problem here with presenting estimates in this manner. And it's highlighted here with this blue asterisk when you look at this hyper growth in quarterly earnings estimate change from the prior year. Note that we're working off of a really, really low base right now because of COVID. So when you start looking at rates of change, they start really, really looking astronomical out here in 2021 because we had it so bad in 20. So just be advised, there's a better way to look at it. And what I like to do is, again, come into the institutional platform. And again, over time, we will be migrating some of these views over to advisor tools. But for the time being, love to look at the FY1, FY2 revision trend to get a full year's picture. So it gives a little bit smoother representation of what's going on with the actual earnings revisions themselves over time. And in this case, what I've done is I've done a right mouse click on the symbol control monitor, gone to load, and in here we maintain lists of composites, or what I used to call composites of composites. And I literally just went down here and grabbed the S&P 500 sector composites market weighted. And when you do that, it'll actually pre-populate all the sectors in the list control. And it just allows you to bump through sector by sector. So I'm going to do this with you very quickly, and you'll kind of see where I'm going with this. Instead of looking at a 1 year, year over year, we're actually looking at the monthly trend in revisions. So we can actually see the impact of the pandemic on revisions per sector, and then we can actually see what has taken place in terms of a recovery for F1, and then obviously in terms of F2 as well. And you can see that the discretionary sector is obviously still in bad shape. And many of these results are the same thing that came out of the Wall Street Journal article. It's just that this is a much better way to look at it because you can actually see the trend. But you can see that staples, almost a recovery from 409 to 389. And we can just kind of bump through here and you'll kind of get a trend. I mean, obviously energy has just been clobbered. You can see that. Obviously the financials still under a lot of pressure. Healthcare doing just fine. Here's industrials. Here's the information technology or the tech sector doing just fine on revisions. Here is the materials sector. Again, we have material stocks in the earnings certain family of portfolios, but they are only a handful of the best of the best. So our stocks have not been hit, but the S&P 500 materials still under pressure. Real estate's an avoidance sector. Here's communication services where the likes of Facebook and Google reside, under pressure. Utilities holding up okay. And the broader S&P from a composite perspective. So anyway, just really interesting to take a look at revision trend versus just looking at year over year. Year over year is fine for this year. If you try to do it for next year, you're going to get burned because those are not normalized growth rates when you're coming off of such a low base in 2020 just due to COVID. So one thing I did want to touch on, I did mention Sheraz's report and remind clients that this is located under market strategy, sector, and market earnings trends. And I'm going to go ahead and pull this up very, very quickly. One of the things that I absolutely love about the report, I always talk about banks, I always talk about the energy sector. And the neat thing that Sheraz does is whatever sectors tend to be skewing the larger trend of the broader benchmark for each quarter, he'll go ahead and split those out. So you get here as an example, and I just scrolled down to page 7 as the very first example, but this is kind of your blended beats on earnings and revenue. And Sheraz gives us the total number of companies that are reported, even a percentage, and then the total market cap percentage. And the cool thing is he does it excluding finance and excluding oil, right? Because these are the two that are skewing the broader S&P the most. So he gives you a look at that overall, and then he looks at the overall excluding finance, excluding oil. And he does that throughout the whole report. So top line beats, bottom line beats, and this is literally updated each week. Year over year growth, the whole 9 yards, very complete. Again, for any of our clients that have to talk to more sophisticated clients of theirs about earnings season, a quick browse through this report once a week will make our advisors just absolutely look like rock stars. So just remind everyone that this is available. And that's all I had for today. And we'll go ahead and get synced up again next Wednesday. Thank you, everyone.